Hello, in this video I'm going to teach you about the Volatility Stop Indicator and strategy, how it works, its strengths, its weaknesses, then we'll look at a quick back test, and I'll show you one or two tweaks you can do to make it even more interesting. All this to help you become a more educated trader and investor. So I'm the Augur, I'm a stock trader and options dealer. I make videos about trading, investing, economics, finance, stuff like that. If it sounds like your thing, go ahead and like and subscribe to see more of that. So let's go ahead and get into the charts on TradingView here. So I've go ahead and loaded up the Volatility Stop Indicator on my chart and went ahead and gotten a strategy together around that, which was actually a little bit difficult. It's kind of a weirdly built strategy, but it just runs off of the true range of a factor. In this case it's set to 20. And a true range of 2, or a range of 2 over the last 20 reflected up and down. So that's how it sets the line. So the way it works, this price comes in here, it breaks above the line, it closes above the line, it buys. If the line follows it up, the line only goes up, it never comes down. It's a trailing stop at that average true range. And it comes up here, and then when it finally does break it, it sells. Then when it comes to break that line, it buys. It's a very simple indicator, just based on true range. It operates very much like the super trend indicator, but there are some slight differences in the calculation. It just has to do with how the period is set. Like this one counts, like if I set this one to 20, it's like setting the super trend to like 18 or 19. But besides that, they're very similar equations. And well, the way it works is this indicator and the strategy, it's not really designed to guess direction. It just kind of follows along as long as the market doesn't break that little line. And that line is based off of the range of the bars. So as long as the market continues the sort of deviation it's trading in, it'll hold that line. See, there's a lot of interesting things about deviation. Like you can see right there, it held deviation all the way down, even on the little bump there, until here, where it broke it on one big bar. And then that started an uptrend, and it really didn't get that much further down below the lows here. And so there is something to be said about the importance of changes in deviation over time, and what those mean when you see them in price. It's just kind of a change in mood of the participant. You see, like again, even though we had a huge drop there, the fact that it bounced back up more than the range of any of the other bounces up over this period was a sign of at least a little bit of strength until it continued lower. But again, it kind of held that line again. It's just interesting to me. Deviation and the way trends build and develop are what I think about a lot. So let's talk about some of the weaknesses. It's a great display of some of the weaknesses right here. Because it's such a tight stop, or it commonly comes as such a tight stop, and people don't really change the settings that much, and it stays like 2 ATR, 3 ATR, it can get chopped to pieces a lot, especially in, reciprocations. At the same time, I mean, it does do a half decent job at catching some big trend moves with low risk. I think that's a very high risk to reward ratio on that trade, even though you had to deal with all this junk. So the question becomes, like on any indicator, does all this junk outweigh the big hits? And then, in addition to that, how can you structure your risk management and your understanding of this data to take advantage of that? So we can see, like, it's been an incredibly bearish market. I'm willing to say that this one is winning more on the downside than on the upside. But you can see it has some upside winners. That one was a nice win. You got 705, like 40 points, and you're really only risking 4, 6. It's good. That's a solid 10 to 1. So I mean, all this junk here could have been beaten out by that trade if you did it right. Maybe, it almost looked all right too. You had a little bump there. She had some mess in here, a real mess. Anyways, let's look at the back test. And you can see it actually performed pretty well here, but it's also been an incredibly trendy period. Let's go look at a couple of other ones once we fiddle around with this. Well, see, if I go ahead and flip it to a 30-minute chart, it doesn't work at all. It has a lot of the same data, percentage profitable, total closed trades, average bars in trade, but it's a big fat loser. Then I change it to the 1 hour, and it's a big winner. So really what this is speaking to is the total volume of closed trades It has like the tiniest edge depending on when you catch it and how trendy it is, but it's not really winning that much per trade, and they're really fast trades. So this is sort of just kind of the buildup of the data. But you can see how a lot of the trades, I'd say 90% of the trades are small trades that don't really go anywhere. Yeah, maybe you have some burn there, but they don't really go anywhere. And then sometimes you have these big moves. You can catch some big ones. So if your risk management strategy was set up right with something like this, and you had very low fees and commissions, if you're a professional shop, if you're working with large volumes, all sorts of robots and fancy stuff like that, you might be able to take advantage of something like this. But you could also, at that same rate, talking about those same sorts of people, you could build a robot that flips coins and just follows for the trailing stop and probably have very similar results. It would be very much about your risk management and your sizing and your financing and cash flow and all those sorts of fun stuffs at that point. So as far as we're concerned, this is going to be something hard to work with. Yeah, you can see it comes in very close. Obviously, it was bearish, so the bull side lost, the bear side won, but so slightly, there's such a tiny difference. It's just the fact that difference is multiplied by like 1,000 times, right? And then this looks like there was one really big trade or two really big trades that changed this data. So the important part to understand when we're talking about something that works like that too, where one or two big trades are what this is chasing and the rest of it just kind of chops back and forth around zero, is you need to have a way to take every iteration. You need to either have a bot or something that's going to take every single setup, because you can't afford to miss the big one. Otherwise the entire thing's a waste, right? So that's the entire idea with that. And this one, it really doesn't look like the big hitters are that frequent. So it would honestly be a tough one to do, especially as a retail trader. That's just my opinion on it. And boom, we have something slightly more interesting to look at with the Volatility Stop Indicator. So I've gone ahead and I've added a very short-term RSI to that, and about 3 length standard settings besides that. And this is now a 1-minute scalper or something similar. And this is how a lot of people set up something similar. So we know from our last episode of the RSI, if you haven't watched that, go ahead and check that out. I'll make sure there's a link in the comments below, where we talk about the function and how that works and whatnot. So we know that it is basically just a moving box. But if we set a moving box inside of a larger trend, which is just itself a larger moving box, we can trade that box inside itself, basically. And that's how a lot of scalpers will function. And it's not like they'll take every single one of these, but what they know is that, like, for instance, after their RSI trigger short, these are all relatively high prices compared to this. So it creates, like I said, like I referenced in the super trend video, it creates a condition where only one of two options can happen. Either this will go up here and break the trend, and then it'll, I guess, stop you out of that trade if you're a scalper, because you're not really going to get in there. You might wait a little bit, get one of these guys. You definitely want to scalp off an uptick, scalp off the ask if you're shorting, and then they're probably going to take it as it falls down here, maybe somewhere in this bar, depending, and that just helps them basically with their risk management, because if the RSI functions as it should, on average, the distance between the top of this box and that box relative to this box, which is this and like this, since this box is set above the midline, if that makes sense, the risk is is not this is not as big as this on average over time. So that's how that would be set up. And this is still a lot more about your risk management than anything else. Like anything else you're gonna do, this thing will have it's times where it's really making you mad. Let me see if I can find, yeah, like right up in here. And this will be a very frustrating time for you. Now, you can come up in here, you have a long, you still made, you got one, you got maybe 2, 3 good scalp. Okay, so you got some good scalping in there. I lied. Let's say on this one, like you're short there, it's going to, like, I don't even know what to do with this one. You'd be kind of in a rough pickle on that trade, have to figure something out. But it doesn't stop you out, it just comes up here and it just, the RSI triggered the exact other way because of this quick V in like 3 bars, which is what happens when you set an RSI to like 5 and then gives you a V and it closes the box. Same thing happens there and there. So it's one of those things where like you might want to think of adding an additional exit factor to this, or I'm sure there's ways you can make this better. Now this is just something I kind of whipped up at the top of my head that I know that is it's not exactly what other people use, but I know some people who will do cycles inside of cycles like this to scalp. So this is kind of a good way to illustrate that that thought process in a technical manner. And like I said, I'm sure there's the way you would go ahead and keep this sort of thing on track is you have iterative testing, whereas you figure out what works best. You're gonna have to adjust with the market as it moves and all sorts of stuff like that. But yeah, we know the RSI works better when it's working with a larger trend. So this is just a good way to display that and then add a stop to that trend at the same time. So there's really no rocket science or magic to it. It's just helping with your thought process. It's supposed to help keep you consistent, if that's the route you're going to take. Then you could have some fun, something like that, right? Pew, 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 pew. It's one of those things where you could just start floating, float bids, and when they fill, go ahead and ask. And just cycle through it. But, like, you still kind of need a big account, because this is only, like, what, 96.5, 92, it's only 4 points. So you need a pretty big account to actually make decent usage out of all these. And these are only, like, even on the SPY, it's only like a 30, 40, 50 cent move. So, yeah, you'd have to, I guess you could scalp, like, YOLO options off this, but it would be very tough. The spreads would kill you. Wow, that was a lot of fun. I hope you enjoyed it too, and I hope you learned something about the trailing stop indicators, volatility stop, super trend. They're all kind of the same sort of idea. And how to use certain oscillators inside of those to help you with certain strategies, and all that sort of stuff you'd have to learn, to follow more in your own data testing, but I hope it was able to point you in the right direction if that's something you really want to do. And with all that being said, you have a great night. Remember to like and subscribe.